Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, Fixing a Position Gone Wrong, we'll take a look at some strategies to consider when an option position turns against you in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Fixing a Position Gone Wrong. Joe?
Nick, thanks so much. And again, as always, thanks to everybody for taking your time to join us today. We have maybe our largest group ever joining us today. And so it gets me thinking, is today's topic, Fixing a Position Gone Wrong, a topic that just is close to everyone's heart? I mean, I certainly know that I've had many a position gone the wrong way. And then the challenge is, how to adjust. And hopefully over the next, 40 minutes or so, we'll go through a couple scenarios, some specific, some in a more broad text that will give us an idea of how to adjust when a position does go wrong. So again, thanks for joining us. And don't forget, please, the surveys that Nick mentioned, I think there are only maybe 5 or 6 questions there. They're incredibly important to us, and they help us decide what agenda and what topics we want to offer going forward. So if you would take the time to just fill in a few of those questions, we'd greatly appreciate it. The options industry, like all industries, has the disclaimer: options aren't for everybody, but we have the characteristics and risks standardized options document, which you need to get either from the OCC or from your broker if you haven't already. For those of you new to us, this and the next slide are 2 of my favorites. It's who we are. The OIC is a educational nonprofit sponsored by the listed options industry, which has been around since 1973. The OIC has been around since 1972. There are now 12 option exchanges, so it's a combination of the option exchanges and primarily the members of the OCC, the Clearing Corporation, that continue to fund our educational initiative. And that is all we do. It is strictly education. I think many of you who know us know that we sell nothing. Everything is sponsored and paid for by the industry, and I feel very privileged to be able to represent such a dynamic industry. This, as I mentioned, is one of my favorite slides because it speaks to the growth in the industry. We go back to 1973 in Chicago, and last year, 2014, was the second busiest year in history at about 4.3 billion contracts, which breaks down to just shy of 17 million contracts a day. So you can see in an environment where volatility has been relatively low, certainly through the first 3 quarters of last year, for us to have our second busiest year in history, I think suggests that there really are compelling reasons to consider and then use options, both for income generation, for risk management, and certainly some folks speculate with them as well, with the leverage associated with the product. So our outline today, we're going to get into a stock repair strategy. So we will start with a long stock position and talk about how we can adjust that to assist in lowering our break-even point. We're going to get into long calls and long puts gone the wrong way, as well as short calls and short puts. We'll look at the covered call position and the risks associated there, and a little bit off, that line, but when it comes to risk management, and after all, that's really what we're talking about here, managing risk, maybe specifically in areas where a position has gone wrong, we're going to talk about assignment risk at expiration. So I mentioned the repair strategy, repair and exit strategies. When something goes wrong, I always found as a trader on the floor for all those years, the thing that actually made me happiest was, and this is a little warped probably, but when I was wrong, if I could adjust my position and not lose money or really minimize my risk, that's when I felt best. I mean, I maybe had a built-in sense of I expected to make money in many of my bid-offer spread trades and positions, which, may be right, may be wrong. But really, the thing that satisfied me the most was when clearly my forecast was wrong, but then I was able to be creative and flexible to offset significant losses. So being creative and flexible is a very important quality when adjusting a position. Now, in order to be creative and flexible, you have to have an awful good base of knowledge. And we'll get into, some of the things like, rolling and things of that nature. So, and of course, managing risk, we want to adjust in a way that fits the situation. And that would seem obvious, but we don't want to compound a bad position by doing something that doesn't make any sense. And the old adage, don't hold and hope. One of the sayings on the floor always was sell hope for good reason, I think. So let's take a look at the stock repair strategy. The stock repair basically starts by buying stock, and one question I enjoyed recently at a presentation asked somebody, what happens when you buy stock? And without a second hesitation, somebody yelled out, well, when I buy stock, it goes down. And often that's the case, unfortunately, for many of us. So we buy stock and it declines. What do we do? The idea of doing nothing is what a lot of investors do. Depending on how far down, it may not be the right approach. Some also consider, they believed in XYZ at $50, and at 45 or 40, they believe in it that much more, and they double up. And that, obviously, you have to have the buying power, to be able to do that. You want to make sure that, potentially you're diversified and you're not putting too many apples into one basket. So holding and hoping, not necessarily an ideal scenario. Doubling up, it really depends on you. Or you could consider, this whole idea of establishing a stock repair strategy with call options. So what the stock repair strategy with call options does is it lowers the break even. On the upside, ideally we try to do this with little or no additional funds, but that really depends on what strikes. We go in and establish this stock repair strategy. Important to note that the downside risk in this particular strategy does not change the original position. Okay, and we'll go through the example so you can further understand that. The trade-off would be we're going to lower our break-even point with the stock purchase that's gone bad, but our upside profit potential will be capped at a lower price. So that again, as I suggested, building the base of knowledge, for options can be a lifelong mission. Depending on how involved you are, it's great to just add new techniques and trading strategies to your particular style. And for many of you, maybe this is something new, this whole idea of stock repair. So let's start with owning 100 shares of the underlying. And what we do is then, once the stock declines, we get into a ratio call spread where we buy 1 and sell 2 at a higher strike. And we try to do this for a break even, maybe a small credit or a small debit. That's the goal. Important, no uncovered calls. What do we mean by that? Well, we've got 100 shares of stock. We're going to buy a 1-by-2 call spread. So the ratio is going to be basically 2 for 2. We're not going to have uncovered calls because that gets us into a whole different risk profile. And the motivation here is to recover the original stock investment at a lower break-even point. That's the motivation. But again, the downside risk remains the same, although there is no additional risk. And if we're able to do the strategy for break-even or credit, obviously there's no additional cash outlay. Oftentimes, depending on the magnitude of the stock decline, the nuance of what strikes to pick is really the decision that has to be made. So, we're going to buy 1 at the money and sell 2 higher strike calls. And generally, depending on the magnitude of the loss, and there's no surefire way of knowing that, in fact, the decline in the stock has stopped. But we'll go through an example to give you a sense for what strikes to choose and how to construct a position. What month? Always, to me, with options, and for those of you who've joined us before, to me, the two pieces of art in the options game are what month, what strike. I mean, if we knew what month and what strike, we'd be so far ahead of the game. But frankly, that to me is where a lot of the nuance and a lot of the fun comes in, trying to establish positions that make the most sense in terms of risk reward and done around the right month and the right strike. So, when it comes to the repair strategy, how far out do we go? There's no black and white answer to that, as is often the case with many investments. It's not necessarily black and white. I would say depending on the magnitude of the decline, the further the decline, chances are the more time you may need for the stock to get back to those levels where you purchased it in the first place. If you decide to do this strategy and pay a debit, obviously, you'll be committing additional money to the position, and that's where you just need to decide: is it better to get out and move on, or do you want to do something like try this particular stock repair strategy? So let's get into the specific example. We bought 100 XYZ at $70 a share. The stock basically has got crushed, and is now $60 a share. So we got a $10 loss, on the stock. And how do we go about creating this stock repair? Well, we're going to basically buy the at-the-money call, the 60 call, and sell 2 of the 65s. As I suggested, that's going to be a 1-by-2. In terms of prices in our example, we get to buy the 60 call for $3.50. We're selling 2 of the 65s for $1.75. So that turns out to be no cost. Obviously, the 175 times 2 is $3.50. So we do that for even money. I think that's a little bit generous, although in a stock that's dropped $10, chances are implied volatilities are up all around. Oftentimes, if you do a 1-by-2, in a stock that's just sideways or trending, in order to do an at the money and a slightly out of the money 1-by-2 spread, it would be challenging to do that for even money. That would typically be a little bit of a credit, or excuse me, debit, because of the natural skew in the marketplace. But with a stock that's dropped as significantly as this one, you have a better chance of doing it for even money. So the stock's going from 70 to 60. We think that at that $10 decline, the stock has a good chance of bottoming out and possibly rallying. Of course, if we liked it at 70, we got to really like it at 60, unless potentially something fundamental in terms of news has come out in the company where maybe we have a whole different scenario or forecast on the underlying. And if that's the case, quite possibly you just want to cut your loss, get out, and start over. But here the scenario is our forecast is still that we believe the stock has the capacity to rally. So we're going to get into this spread. Again, stock down 10 points. We want to buy 1 at the money, in this example, the 60 call, and then we're going to sell 2 of these 65 calls, and these are 2 months out. These are 2 months, 60-day options. And as I said, no further downside risk by putting on this position because we've done it for even money, but we still do have the risk of the long 100 shares. So at expiration, the long XYZ at 70, we're long 160 call and 2 short 65 calls. Let's take a look at a couple different scenarios. With XYZ at 60 or below, and again, try to think conceptually. What do we have here? We've got 100 shares of long stock, and we've got a 60, 65, 1-by-2 call spread. Long 160, short 2 of the 65s, and we've put that on for even money. So conceptually, if that 1-by-2, if the stock continues to tank, what's going to happen to that 1-by-2 spread? Try to think in terms of the whole picture as opposed to just the individual option prices. So knowing that we've done this for even money, the downside risk is non-existent. There is no additional risk because if the stock's below 60 at expiration, we know that the 60 call goes out worthless. The 65s are, of course, going out worthless. And the key being that we did this thing for even money. So we'd be out commissions, but no further risk to the downside. As stated a couple times before, we do have risk left in the position. We've got 100 shares of that long stock, and we continue to lose money on that to the downside. How about XYZ between 60 and 65? Well, we've got the stock. We purchased that at 70, so depending on where we are, we're going to be down somewhere between $500 and $1,000. But that 1-by-2 spread, this is where, and this is the motivation for putting that spread on. Let's take a look at the stock at, say, $62 at expiration. What's the value of the 60 call? 60 call at 62 at expiration is going to be worth $2. The 65s are going to be $3 out of the money and worthless. So we'll have taken in $200 at 62. So we lost $800 on the stock, but gained 200. We got 200 back with this 1x2 option trade, so our net loss would be $600 rather than 800 at 62. And that's the whole point of this thing, lowering the break-even point for the underlying without incurring any additional downside risk. At 64, it makes sense that we would gain $400 in the call spread. So the 60 call at expiration with the stock 64 would be worth $4. The 65s would be worth nothing. So we have, been able to bring back $400 into the account for a net loss of $200. Stock down $600, and the call spread giving us back $400 for a net loss of $200. And that, again, is the point of this 1x2 60-65 call spread. At 65, and as the presentation outline suggested at the end, I want to just touch on pin risk at expiration. With the stock at 65, we obviously have a $500 loss on the stock purchase at 70, but we've got a $500 profit on the option spread. The 60 calls are worth $5 with the stock at 65 at expiration. The 65s are worth nothing. And so that's going to be our new break even. $65 rather than 70 is going to be the point at which we've lowered our new break-even point, and really that's the whole point in trying to consider this 1x2 stock repair strategy. Lowering your break-even point, and then at that point deciding, okay, I was wrong, I lowered my break-even point, I'm now out at 65 and going to move on to something else, or potentially reconsider and initiate, a new position in this. Because with XYZ above 65, any stock price will be offset by that other short option, that other 65 option, that at 65 is worthless, but anywhere above 65 offsets that long 100 shares of stock. So again, think conceptually if you're able to. Stock was 70, it tanks to 60. We put on a 1x2 vertical call spread, same month, the at the money and then the out of the money. We try to do that as close as we can to even money, a credit or a slight debit, and from there we're able to lower our break-even point in the underlying. That's the whole motivation. I think we got a chart here that suggests, we've got the stock price in the left-hand column and the all-important P&L in the right-hand column. And so this is the 100 shares of stock with the 1x2 call spread. And as you can see, I like to, my focus, as a trader has always been, where's my risk? So it's that bottom right-hand corner that catches my attention first. As you can see, if the stock, will continue to fall from 60 to 50, we, again, still have the risk of those 100 long shares of stock. And that's the important thing I think investors should be keen on. Where's my risk? And figure out whether it's long stock, short options, long options, but where is my risk, and is it quantifiable or is it open-ended? And as we talk through the 1x2 example, we know that above 65, our break-even was going to be zero. Or, well, 65 was our break-even on the $70 purchase of the stock after the 1x2. But if the stock continued to 70, 75, or 80, which was obviously our initial forecast, we would not make any money. And that's why if we get to break even, it's time to reevaluate, what do I want out of this underlying, what's my forecast, and do I want to commit capital to this particular stock or index? So, basically, what were the objectives? We've gone over that a few times. The whole idea is to lower the break-even point and then reevaluate. If XYZ goes back to 70, and I don't even think you got to wait till the stock gets back to 70 unless it's flying one day. By the time you get back to break even, it's time to reconsider, do I want to shut this thing down and initiate a new position, or as I suggested earlier, do I just want to move on? Things to consider, what strike prices, and I think the bit of a challenge there is, okay, the stock went from 70 to 60. Is 60 a short-term bottom? Well, there are lots of different tools to try to analyze, where stocks, may at least find some support. Good old trend lines, Fibonacci ratios, things like that may help you to have additional confidence in picking a particular strike price. What expiration? Again, I think the further the decline, probably the longer it's going to take for a stock to get back to the level that you're looking for, and you just got to be sure that the option prices make sense in order for you to move forward with something like this 1x2 stock repair strategy. So that's the stock repair. Again, we start with a long equity position or index position, and then get into a 1x2, in our example, call spread in order to lower the break even. So let's talk conceptually about some other adjustment choices. Let's just think in terms of long calls or long puts, so quantifiable risk. But whether we bought XYZ 50 calls, XYZ 40 puts, whatever we bought, were long options, and those prices are decreasing, before expiration. Our forecasts were wrong, the implied volatility changes, and options get crushed, all kinds of different things that can happen in the marketplace. So a few of our choices, again, before expiration, position going against us, close the position. Sometimes the very best choice. And one of the reasons I say that is because, and it's hard to do, taking a loss is a discipline that is hard to do. For those of you who are very successful out there in the option space, my guess is you're pretty good at taking losses. It's a discipline that can take years to develop, and it's also a discipline that some investors just never develop. But, that discipline of closing a position, the reason I think it can be such a good approach is that, once you're out, sure, a loss lingers, for a little while, especially if, your underlying turns and goes the way you want it to, and, you're out. But the nice thing, at least that I always found as a trader, was that, by closing something that's gone bad, after some period of time, hopefully not too long, it's out of my mind. I've moved on to the next thing. And because of my discipline and because there are so many different opportunities in the marketplace, closing turned out to be a good idea rather than, getting into something that maybe gets into a bigger position than I actually want. Another possibility is to consider rolling, and there's nothing wrong with rolling. That is really the other key choice versus just getting out. And rolling, may be because you truly believe in that forecast, but you just either need more time, you got to roll down to a different strike because of things that have changed. But rolling is a very, very viable approach to changing a position that's gone bad. Actually, Nick and I did a 3-part series on specific rolling. I think that was the summer, early fall of last year, and as Nick mentioned, a lot of those, all of those webinars are, posted on demand, and I think the YouTube channel, so you can check with Nick with that if you're looking for them. But rolling, and when we talk about rolling, you can roll up a position, you can roll the position down, and of course, whether it's a call or a put, That's a huge difference, whether you're rolling, to something more in the money or out of the money. But when we talk about up or down, generally we're talking about the same month, the same week, whatever the case may be. When we roll out, obviously it's just that. We're buying time. And, if you roll out the same strike, clearly it's going to cost you money. If you roll out and up with a call or out and down with a put, you may be able to do that for a credit, depending on how wide the strike increments are and the implied volatility skew as you go out in time. So again, this is it's not for the novice option user, but as you build your base of knowledge, these are very viable, really not very complicated potential ways to roll around a position going bad. And then the other choice, you can roll up or down and also out all at the same time. So one thing to always keep in mind is, are you doing these adjustments for even money, for a debit, or a credit? And obviously, if it's a credit, you're taking some money in. If you're doing it for a debit, you're committing additional capital to a position that from the outset has gone against you. So just always an important consideration. Other possibilities before expiration with an option long call or long put that has decreased in value, double up. And I think me personally, I tend to be pretty cautious about doubling up, but I include it in the presentation because it is, it's a viable, it's a viable choice. If we, believe enough in our underlying forecast, it is a viable choice. Obviously, if we're going to double up, we're committing additional capital to the position. We have to be able to afford that position and be able to manage the increased risk. So that was the long side, long calls, long puts. Short calls and short put positions really speaks to a different risk profile. Option price increases. If we're short calls and short puts, we're now talking about options that are going up in value, against the short positions that we've established. As the slide suggests, these are high-risk positions, certainly far higher risk than a long call or long put, although if you buy a $20 call or put, you got a heck of a lot of risk with the $20 call or put. You could lose up to $20. The short call and put positions do require far larger margin requirements because of the associated risks. Short calls theoretically have unlimited risks because theoretically an underlying could go to infinity, where the short puts, you've got the difference between the strike and zero as your definable risk, but significant risk nonetheless. Again, going through a couple different considerations, we could certainly close the position. And again, I think that gets back to, you could do that randomly, but I think the better option users have specific disciplines where particular positions go against them some percentage, either of the position itself, the underlying moves a particular percentage, or they sometimes look at their overall portfolio and define how much they're willing to lose in a particular position, and if we get to that point, they shut it down. So closing the position is a viable option, and rolling can be as well. Again, rolling is a little more complicated. On the short side, you've obviously got to believe in your underlying forecast, and you will be looking for either more time or just rolling up to a different strike. Short position, we could, with the naked short calls and puts, you could obviously just buy back and cover the existing position. If we need more time, as I said, you can roll out, and then part of I guess the nuance of all of this is trying to decide whether to roll, stay in the same month or roll out in time as well. So, the goal is obviously just to prevent substantial loss, in this short contract scenario. There is the possibility of spreading. We didn't talk about that on the long call side, but you could do it on the long call or put side as well as the short call and put side. The significant difference, though, is on the long call and long put side, you've already got a quantifiable risk, whereas on the short side, on the put side, it's quantifiable but very significant, where on the short call side, it's not quantifiable. So that's where, potentially rolling into a spread position makes sense. So if we're short a call, we're obviously going to turn around and buy a call, and therefore we're spread off. We're short a put, we're going to do the same, buy a put. Depending on what call or put we buy, will define how much additional risk we have going forward. So oftentimes, there are really two key roles, when it comes to spreads. You can convert into in the example here, it's a bear call vertical spread that I'll go through. You can also roll on a diagonal basis, which, keeps you short the front month, but allows you to either buy the out-of-the-money put or the out-of-the-money call. That would be the diagonal roll, or the time spread, where you just stayed the same strike and bought time. Could also be a possible roll scenario. But let me go through the vertical call spread. The original short call position we sold in XYZ June 50 at $3. Forecast obviously was for the stock to, just be neutral or go south. Well, the stock turned and ran to 55. There's still timed expiration, so the June 50s have $5 of intrinsic value, and because there's still time left, another $2 in time premium. So the June 50s have run from $3 to $7. So our forecast has been, close to dead wrong. Rather than just cut our loss, we decide to buy the June 55 call at $2. So we're short the June 50 for 3 and short the June 55 for 2. And that puts us into this bear call spread for $1 credit. And the downside profit potential is going to be whatever the credit is that we've taken in for this spread. So we've done this thing for $1. The max we can make is going to be $1. And, the maximum loss is going to be the difference between the strikes, the 50 strike and the 55 strike, $5 increment, less the $1 credit we take in. So, if we still do believe that the stock is going to turn and head south, we can try to save ourselves, some money by putting on the 50-55 call spread. But most importantly here, the forecast has been wrong. If the stock were to continue to take off rather than have unlimited risk, we've capped our risk at $4. So that's, rolling into, in this particular example, a bear vertical call spread. Let's see. I'll get into the covered calls. I just, on the call spread, I want to go back just to the call spread for a second. Just so, again, think conceptually. If we're selling the 50-55 call spread, and we cap ourselves there by buying the 55 calls at 2. Again, if our forecast turned out to be right, and that stock, went down to 53 and then below 50 at expiration, what would we possibly make, if we had rolled into that 50-55 call spread? Well, it would have, our maximum profit would not have been obviously the $3 we sold that original call for, but it would be the difference between the call we bought, the call we bought and sold, just that $1 credit. So the key in rolling to a vertical is believing that, the stock is not going to continue to run. We still have a chance to get some money back, but we've capped our upside exposure, and that's the key. So, because that risk reward, between making $1 versus losing $4 is no bargain. But the reason we got into that is because our forecast in the first place turned out to be wrong. So that's just the point I wanted to emphasize. So let's get into the covered call a little bit before we go to assignment risk and then some Q&A. Covered call, the stock price increases. So, what are the possibilities? At expiration, if the underlying is at the strike or above, we don't have to do anything. We can accept assignment, and that'll be our optimum profit point. Possibly we made money in the underlying going to the strike, and then we made money in the premium we took in for the strike or selling, the call. So we realize our maximum profit with the covered call increasing and going through the strike at expiration. Now, if the strike price is if we're before expiration and the stock goes to the strike and our forecast changes, in other words, we think that the stock may be vulnerable, you can consider buying the call back, selling the stock, and closing out the position. Now, of course, you would give up, whatever premium you had to do that for. Obviously, you'd be leaving that on the table. But that's where, active management of some of these positions, not to suggest, you're going to sit there all day and manage this thing, but, just keeping, some decent eye on your positions is always important. So, and just one general stat of, I mentioned early on that we're doing about just shy of 17 million contracts a day on average. Over 70% of the contracts traded on the exchanges are closed before expiration. One thing, especially with retail investors, that I try to emphasize is once you put on a position, don't feel you have to hold that thing into expiration. The market is a dynamic marketplace. Prices are dynamic. So the vast majority, over 70%, are closed prior to expiration. So the covered call, let's talk about the stocks declining below the strike as we get close to expiration. Again, we don't have to do anything. If the stock just before or at expiration is below the strike, we'd be long stock at expiration, and then the calls would go out worthless, and we'd have the possibility of rolling into another call if we decided to. So as the stock price declines, you can do nothing. If we're no longer bullish, again, we can close out the position, or we could buy back our short call that maybe doesn't have a lot of premium left because we're close to expiration, and sell either the same month further out or even roll down, and that would give us more downside protection. So, these are just the different choices that are available for us in our various positions. So before we wrap, just assignment risk at expiration. Again, managing risk is always key. Short in the money calls or puts at expiration, we're going to get assigned. And what we mean by that is, by selling any option, we take on an obligation. We sell a call, we have the obligation to sell the stock. If we sell a put, we take on the obligation to buy the stock. So if that option is in the money by any meaningful amount right before expiration, we can expect assignment, and clearly at expiration, if it's in the money, we know we're going to be assigned. If we are short and at the money call or put at expiration, we don't know. The buyers of options, they have control of assignment risk. They decide whether they're going to exercise or not. They paid a premium for the options, so they have control of that underlying that the option is controlling. So if assignment risk is not something that you want to deal with, if you don't want to have the obligation to either sell or buy the stock, you basically got to close your short option position. The whole idea of options at the money at expiration gives you pin risk. So just know what you want. Know whether you're willing to, buy the underlying if you're short the put, sell the underlying if you're short the call. Maybe you have stock to offset that position, but if assignment is not acceptable, you have to take action. And by that, you got to go in and buy that call or put. And if you have another side to the trade, get rid of that as well in order to have basically a neutral zero position coming out after expiration. So with that, Nick, I think that takes us to some Q&A. I would just say optionseducation.org is our website. We've got 7 drop downs there with many option tools. We've got our investor services desk at 888 Options. They're there 5 days a week for any of your option questions. We got our mobile app and the YouTube channel that Nick mentioned early. So what do you got, Nick?
Well, Joe, we do have a number of questions today, so I want to remind our listeners before we get to them that they can fill out that survey right now. We'll really help planning the rest of our sessions throughout the 2015. And to follow up on Joe mentioning our investor services team, give them a call at 888 Options. If we're not able to get to your question today, they're available during normal business hours and can help you with any option strategies or positions you might have questions about. Well, Joe, with that, we have a couple questions, and I think I got this a few times, and this listener would like to know if you could just go into the basics of what it means when you roll a position.
Okay. Rolling a position would suggest that we have started with some position. So why don't we start with a $50 stock and a $50 call. And let's say it's a long call position. We have a forecast that we think the underlying is going to go up. That's why we bought the 50 call in the first place. Some time goes by, and let's, for an example, just say it's a 60-day call. 30 days go by, and the value, the underlying, has not started to go up as we had forecast. So the value of our call option has decreased by about 35%, and we've got 30 days left expiration, but we're 35% underwater. And as those who are in the option space know, as you get into the last 30 to 45 days, that's when the time value portion of an option starts to decay at its fastest rate. So since the stock hasn't moved for a month the way we expected, and we know that we have this accelerated decay staring us in the face if it doesn't move over the next 30 days, by rolling the position, we would take that original $50 call and roll it, sell that $50 call, and then buy another call. And our choices could be to buy a $50 call further out in time. It could be to buy, let's say strike prices are every 5 points. We could roll up to a 55 call, and obviously the 55 call is going to be less expensive. So possibly, although we've lost 35% of our investment, possibly you could buy 2 of the 55 calls, but of course they'd be further out of the money. So that's what we mean by rolling, Nick. And typically on a roll, not always, but more typically, we're rolling because our forecast hasn't been correct. So when we roll, we have to sell our initial position, typically for a loss, and then we roll out to one of the other We may have to put additional capital in. We may be able to do it for even, but typically, because we're rolling, we have to sell that initial position out for a loss, and then we are buying more time by rolling into a different month.
Joe, when you were discussing stock repair, are there alternate strategies that you could use to get the same results? A put spread, for example, a 1x3 spread, a 1x4 spread?
Well, a lot of actually, you hit a lot of things with that question, Nick, or our listener did. Let's start with a put spread. Okay, puts obviously give us the right to sell the underlying. If we have a position that's gone wrong, now depending, maybe we don't know whether it's a debit spread, just a long call, long put, short call, short put. Hard to know what it is, but we could, and actually one of our examples spoke to rolling into the bear call spread. So we could roll into a spread, and depending on what the initial spread was, it could be a put spread. So rolling into a spread is a possibility. What that is going to do, though, is unquestionably it is going to reduce your profit potential. I think in our original bear call spread example, the original position was we sold the call for $3, and when we were done with the spread, the most we could get back was $1. So you're going to reduce your loss and most likely you're going to reduce your profit and most likely lock in a loss, but you'll have cut your risk potential significantly by rolling into a spread. And then you talked about doing a 1x3 or maybe a 1x4. I'm glad actually, an investor asked about that. When I was going through our example in stock repair, we were very specific to the idea that we had 100 shares of long stock. We got 1 at the money call and 2 short out of the money calls. So we were 2 on the long side, 2 on the short side. By doing a 1x3 or a 1x4, clearly, and depending on what strikes you pick, clearly you have an opportunity there to be taking in a credit. I mean, if we go back to our original example, the call was 3.5, the 60 call, the 65 call was 1 3/4. If we did that by 1x3, we'd be doing it for a 175 credit, 1x3. But 1x3, we're no longer a hedged position if this stock takes off. We're naked short a 65 call. So that's where getting into some of these ratio spreads, importantly, your risk profile changes. Now, that's not to say you can't adjust that risk profile. The risk in getting into a 1x3 or a 1x4, let's go through the 1x4. Obviously, if we bought the 60 for 3.5 and sold 4 of the 65s for 175, we'd be doing that for a $3.50 credit. Okay, so it's easy to collect credits, but in essence, you're just talking about additional short options. And with additional short options, there's significant margin requirements because of the risk, and there is the risk. And of course, we can adjust those positions if things go, kind of nuts against us in a ratio spread. The real risk in ratio spreads is a corporate announcement when the markets are closed, where you can't adjust until the stock opens the next day. So if that $60 stock, let's say we did a 1x4, and our forecast had been for the stock, really we're very bullish. We bought it at 70, it went to 60. Well, maybe something happened on the corporate side, and all of a sudden that stock's 80. It's not going to take you long to figure out that we're excess short $65 calls, and at $80 we're out a lot of money. And getting back to our original forecast, it was a bullish forecast we had. There is not, I told you, what used to make me the happiest on the floor is when I was wrong and, trade around and cut my losses and didn't lose a lot of money being dead wrong. There was nothing worse for me to have a forecast, change my position, have the underlying go the way I thought it was going to go, and then lose money because I, had adjusted to the point where I hadn't managed my risk well enough. So that's a long explanation, Nick, but there are a lot of different scenarios in that question.
Joe, when is the best time to roll a short put? Is it when the put reaches the at-the-money point?
My immediate response is, I don't know. What is because that best time is, rolling a short put. For me, when am I going to roll a short option? It's when my forecast is going wrong and, I have a threshold where maybe I'm willing to be, wrong by some percent. And once I exceed that, that's when I'm rolling. I think it comes down to, management of capital. I wouldn't necessarily, ideally that short put, you're getting fairly close to expiration, so you've been able to, take in a fair amount of the time value, unless of course, the implied volatilities have gone up. So, unfortunately, Nick, I don't have a best time because there are just too many variables.
Joe, is there going to be more risk with a long or a short option position?
Well, I was going to say, what do you think, Nick? But that would be unfair. Without question, and I know you know the answer, Nick, but without question, it is short options. And that is because, as I said earlier, short options, you incur an obligation. You get paid, whatever the premium is for that short option. But that's the most you can ever make, whatever you sold that option for. And, in the case of the calls, theoretically, they can go to infinity. The puts, can appreciate to the point where the stock is zero. So it is the short call and the short put that incur far more risk than the long call or put. The long call or put, if you buy an expensive call or put, you got a lot of risk, but that is your maximum risk. And that's where, we talked about the idea of spreads quite a bit, throughout the presentation. Spreading off options can be a very good thing.
Joe, what would be a good strategy, a good basic strategy for a high volatility stock?
A high volatility stock, a good basic strategy. Well, if you're talking a high volatility stock, depending on the amount of capital in your portfolio, I especially like to trade them, on a spread basis. Because, when you're talking high volatility, you're talking a whole lot of time premium. And, to offset some of that vega and theta risk, I like to do spreads. So in a very general sense, Nick, for me, it's spread trading.
Joe, should investors look at long straddles as a possible viable strategy if implied volatility is fairly low?
Well, certainly long straddles and strangles are very viable. Long theta positions and long gamma positions. We're talking Greeks here a little bit. So long theta obviously is the decay that you pay, every day. And if you're long a straddle, that's going to be long the at-the-money call and put. Pick your, same month. And the difference between the straddle and the strangle is that the strangle also same month but different strikes. So typically the straddle is the at-the-money where the strangle are the out-of-the-money. So the strangle is going to cost more than the straddle. Just be mindful that, if that stock sits, and the options aren't moving, really the only way to offset the theta in that long call and long put position is by day trading the stock back and forth. And actually, for pros on the floor, that's what we would do all day long. If we felt that the implieds were at a favorable level, we'd be long options and then just trading the gamma that comes from those long positions. And by that we mean as the stock goes up, if you're long options, your delta gets long. So as you get a long delta, you pick your point where you want to sell some stock, and then you hope that maybe it reverses and goes down, and you can buy that stock back, because as the stock goes back down, that delta, which maybe you hedged at zero with the sale of the stock, would then start to go to the negative side. So you get to buy stock as the stock declined, and that's basically gamma trading, which not really too many retail investors do, because that's more towards heavy trading from a day trading perspective. So it's not all that typical, but if you believe in the level of the implied volatility, and many of our listeners, I'm sure, have heard me say, investors can make and lose quite a bit more money. Certainly, professional traders make and lose far more money trading volatility than they do delta, and that's not necessarily the case for the retail investor. But if you believe in the level of an implied volatility being quite low, buying that straddle or strangle can be a real reasonable strategy.
Great. Thanks, Joe. We are right at our 1 hour time limit, but we do have time for one last question today. And this listener wanted to know your thoughts on using back spreads as a viable strategy to fix a position.
Okay. Back spreads. Let's start by defining a back spread. Let's go back to our $70 stock. And if the stock goes from 70 to 60, the question there is, what back spread do we want to initiate? And that's going to depend on how quick we think the stock can recover. If we, and by a back spread, that means you get net long options. So I would not, really be in favor of the 60-65 back spread, because if the stock tanked from 70 to 60, basically what we're doing is raising our break-even point, depending on whether we do that back spread for even a debit or credit. We have additional risk. If we, the back spread, you're going to sell the at the money or in the money and buy the out of the money. So it's not exactly opposite of what we were talking about, but importantly, we are selling an either in the money or at the money option, and then we're buying out of the money options. So to me, I like the idea of the stock repair because it lowers our break-even point for a forecast that's going wrong. Back spreads are, in my opinion, viable trading spreads, but not necessarily a stock repair. Low volatility, in a stock that I think, is going to have some significant upside or downside, whether you're doing a call or a put back spread. Real viable strategy, takes some management, but I wouldn't opt to do it necessarily in a repair situation.
Joe, thanks for your time and expertise today. Do you have any closing remarks for our listeners?
No, Nick, just I thank everybody for joining us, and I know, as you'll probably announce, our colleague and Director of Education, Alan Grigoletto, will be offering the next webinar, and I think it's March 3rd.
That's exactly right, Joe. Please make sure to sign up for that upcoming webinar if you haven't already done so. Ladies and gentlemen, we appreciate your time this afternoon, and as we've mentioned, today's session will be archived. It's available a few hours from now using the same link you used to join us today. Additionally, our webinars are available on the OIC's YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. Go to YouTube and search for Options Industry Council, and it'll take you right to our page. While we weren't able to get to all of your questions, as I've mentioned, we have our investor services desk ready to help out at 1-888-OPTIONS, available during most business hours to answer your options questions about strategies or approaches. Feel free to reach out to them. Make sure to check out optionseducation.org in the upcoming weeks for the remainder of our 2015 schedule. Look for the one featuring our our Vice President of Education, Mr. Alan Grigoletto, who will be talking about put-call parity at our next one in March. Feel free to sign up for that and send the link to your friends. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.